Okie dokie. Okie dokie, everyone. Hello there. This is James. And James, your chief trading educator here at Stratton Markets. Can I start off with saying to everybody either a happy good morning or good afternoon or good evening, depending on where you are around the world. And thank you for joining me on tonight's webinar, which is all about how I started to learn about technical analysis. Written obviously by myself, James Truscothick, your trading educator. Now, before we get on to a bit of an introduction on myself and obviously tonight's agenda, we are going to be talking about online trading and CFD trading. And like with every single investment, it does indeed carry a great deal of risk. I do suggest you do your own due diligence and your own research and know the risks at hand before entering any trade. Now, with that out of the way, this hairy, slightly pot-belly individual here is yours truly. That's right. Like I say, my name is James Truscothick. I'm the Chief Trading Educator here at Stratton Markets. I have over 20 years experience in the financial service industry. I actually started out at a plucky age of 18 years of age. I'm now 40, not 50, like a lot of people say, but actually 40 now. I started off as a mortgage broker, specializing in buy-to-let and commercial mortgages before moving into pensions and alternative investments. I entered the online arena around about 12 years ago, where I actually indeed have traded myself for a prop company through the Dubai Gold and Commodity Exchange, and I've also ran a floor at the Philippine Stock Exchange before moving into portfolio management and then, of course, education. I am indeed a published writer. I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, The Street, and several newspapers, including City AM and FX Traders Magazine. I am an avid market commentator. I'm very passionate about the markets, and I'm also a well-known public speaker, and I've actually spoken around the world at several market events and industry events. So yes, and like I say, I am an educator, and I do have a great deal of experience and passion and knowledge, which I'm looking forward to sharing with you tonight. I never once call myself an expert, so I won't be showing or sharing with you any hidden secrets, because I don't believe any experts exist in this field, and I don't believe there's any secret formula either. Now, tonight's agenda, like I say, we're talking about technical analysis. So tonight, we're going to start off with discussing what is technical analysis. Then we're going to have a little bit of a, conversation about technical analysis versus fundamental analysis. What's the key differences, etc. With the theory behind using technical analysis in your trading, introduction to moving averages and Bollinger Bands, and using the RSI to see if the market is potentially overbought or oversold. Then we'll discuss some up-and-coming events, other future educational events I will be holding, and of course, the usual question and answer session at the end. Now, there we got that agenda on the way. Let's put me on so you can actually see. There I am in the corner there. Hello there. So, right. So, what is technical analysis? Technical analysis is a method of trying to establish potential future direction of an asset by studying past price data and volume. Now, fundamental analysis, on the other side of things, is the method of analysis to try and identify the actual intrinsic value of an asset. Fundamental analysis studies the overall picture by taking into account economic, industrial, and financial conditions which could affect that asset. So it's the actual intrinsic value. Technical analysis, on the other hand, technical analysis assumes that the fundamentals are already factored into the value of the asset, so it ignores the intrinsic value altogether. Instead, technical analysis attempts to recognize patterns and trends to try and predict future movements of that asset. So that's the key difference. One really looks into the nitty-gritty, the background information, the overall data and things which could actually affect the intrinsic value, whereas technical analysis, or people who trade technical analysis, say, I'm going to ignore that. That's already factored in. I'm going to see if I can identify patterns based on previous price action, etc. Now, the theory behind technical analysis is that previous trading activity can tend to give a better indication of what the direction of an asset may go, what the buyers and sellers are actually doing. That's the theory behind it. You know, the basic concept was actually developed by the Dow theory, by the writings by, cleverly and very inventive here, by Charles Dow. The Dow theory believes that price movement is not random, but in fact it actually follows patterns and repeating trends. Now, when it comes to technical analysis, there is a number of what's called technical indicators, which traders tend to try and use to try and see if they can identify these patterns, these trends, and where the asset may go. Example of such technical indicators include, like I say, they take into account price, volume, and demand over a period of time. That's how they calculate it. Okay. Now, an example of such technical indicators includes the likes of the Relative Strength Index, RSI, something we'll talk about today, stochastics, MACD, Bollinger Bands, again, something which we'll discuss today, trend lines, simple moving averages, again, something we were introduced today, and commodity channel index, just to name just a few, because there are hundreds of these different indicators, which people tend to believe in or traders believe in, etc. But we're just going to focus on just a handful. I'm going to go over a handful of those tonight. Let's start off with the simple moving averages. I've got my own presentation there. So, simple moving averages. Simple moving averages, or simply SMA. Okay, SMA is calculated by adding up the recent closing price and then dividing it by a certain time period. So say, for example, they take a closing price of an asset and they divide it over, say, the last 10 trading sessions, for example. Now, the simple moving average is often used to try and identify a trend and at the same time used to spot potential support and resistance levels. Now, here's an example here. Okay. Now, here's the theory. If an asset is trading below the simple moving average, it's on a downtrend. If the asset is trading above the moving average, so if the asset is trading above the moving average, then it's in an uptrend. So below, downtrend, above, uptrend. That is the theory. Now, if it's below the moving average, the theory is that SMA will now act as a potential resistance. And if it's above the SMA, that will act as a support. So here's an example here. Okay, let me get the pen as well so we can, nice shiny pen. Let's go for laser pointer. Wow, yes. So as we can see, it's under the moving average, so it's indicating it's a downtrend. Okay, and indeed the asset is moving in a downward trajectory. This is the euro, actually, example, okay, on a daily time scale. And as you can then see, it came up to the SMA, as it did here, and it did indeed act as a resistance, and it carried on falling down in a downward trajectory. It bounced above it. As soon as above it, it was an uptrend, slight uptrend there. There, it sort of acted again as a support before finally breaking it, moving underneath it, and carrying on with the downtrend. Broke above it, acted as a minor support here, but then eventually broke it and became a downtrend. And again, look, like I say, the SMA then acted as a resistance, keeping that asset down. Now, there's another theory. Let me have a quick sip of my drink, 1 second. Lovely. There's another theory, okay, that not simply we're using one SMA or one moving average, to try and see if it's an uptrend or downtrend, support and resistance. There is another method where people use two SMAs. They call this the moving average crossover. Now, the moving average crossover can be used, or so the belief is, or so the theory is, can be used, okay, to identify if a trend is about to change, which can then potentially enable the trader to be prepared and get a better entry level. Now, this theory happens when moving averages, when a smaller SMA, simple moving average, crosses over a larger SMA. Sounds intriguing, James. What does that actually mean? Well, here's the theory. What I mean by smaller SMA crossing over a larger SMA is this, is you take an SMA with a smaller time period, say 10, and you then put in an SMA over a larger time period, say 20. Okay, so what we have here, if you look at our screen here, we have the moving average here, we have it 10, and that's the blue, it's the blue line, the blue moving average is a 10, so the smaller. We have a 20 on our chart as well, which is purple, so that's the larger SMA, okay? So, as we can see, the smaller, the 10, crosses below the 20, the larger, and indeed, the asset started to move downwards. It tries to cross over slightly, but it doesn't quite, so it carries on below the larger, so it carries on its downtrend. Again, it tries to cross over, but it doesn't quite break it, carries on below it, and carries on the downtrend. Now, what's also interesting about this is the theory is that when it also crosses under it, gives you the idea where the trend is potentially going, is that the smaller SMA then acts as sort of like a resistance, okay? And then a support if it crosses over it. As you can see, obviously, it's acted as a resistance there, keeping the asset on a downtrend. So there's a theory. If the smaller crosses over the larger, indicates the trend is changing, possibly going on the uptrend. If the smaller crosses below, I'm doing a dance, smaller crosses below the larger, you can see it indicates it's on a downtrend. And here's another example, this case on an uptrend. Excuse me. So as you can see again, the smaller is the blue, 10, and the purple is the larger, 20. This is the dollar yen, again on a daily chart. Okay, so the blue crosses above the purple, so the smaller crosses above the larger, indicates an uptrend. Indeed, it carries on in this uptrend. Crosses below it, slight downtrend for a little while till it crosses above it again. Crosses above it, then indicates a uptrend and carries on going up on its uptrend until eventually it gives us a false signal, because this is something I will make out. I call indicators, they occasionally work, but they don't always work, of course. So a prime example here, asset as in the dollar yen started to collapse, but the small still stayed above the large and didn't really cross it till way down here. So again, it's not 100% foolproof like all indicators. And the other thing about the moving average, because it's calculating closing price, it's called what's known as a lagging indicator. So it won't take into account any breaking economic news or breaking headlines or breaking things like that. So this is why, like I say, again, you need to be aware of what is also going on in the market, not just relying on indicators. Again, that's just my opinion. Bollinger Bands. This is another very popular, very keen indicator which is used. Now, Bollinger Bands was developed, again, they're incredibly creative with these names, was created by a chap, surprise, surprise, called John Bollinger in the 1980s. Now, traders tend to use Bollinger Bands to measure market volatility. Market volatility. The theory is that when the bands are wide apart, okay, the market is volatile. When the bands are closer together, the market is not so volatile, it's actually ranging. Now, Bollinger Bands do indeed consist of a moving average, and traders trying to use Bollinger Bands, to establish the volatility of that asset, but also to establish potential support and resistance levels. Again, it's all about the support, it's all about the resistance. Now, here's an example. Okay, so here's our Bollinger Bands. There's the top band, here's the bottom band, and here we go in the middle is our moving average, the shear moving average of 20. Okay, so here's the theory. When the bands are wide apart, as you can see, that band is very wide from that band, means the market is volatile. And as we can see by the size of these candlesticks, it is indeed pretty volatile. And as you can see, the theory goes that the bottom band acts as a support and the top band acts as a resistance. So let's have a look, see how this asset did. Okay, top shift band started to move up, hit the top band, started to move further downwards. Again, bounced on the bottom band, which acted as a support, bounced upwards again, and hit the top band, which and then acted as a resistance, pushed it further downwards. Again, bang, support, bang, resistance, bang, resistance. You say you have the support there as well. Now, Bollinger Bands, a lot of traders really tend to look at Bollinger Bands and try and trade it when it's ranging, because when the bands are narrower apart, are closer together, sorry, as you can see here, the market is, like I say, less volatile and it's more likely to range. And as we can see here, it ranged between the two bands, quite cleanly there. Now, the relative strength index, or simply known as the RSI. Now, the infamous, as I call it, relative strength index, is a momentum indicator, which can be used to measure if an asset is overbought or oversold. Theory being that if something's overbought, the market might start to sell off. If the asset is oversold, the asset might start to be buying up again. Now, the RSI has the value between 0 and 100. I can do 100. I've only got two hands. The theory is that if the value is above 70, the asset is potentially overbought, and that could cause a sell-off. And if the value drops below 30, the asset is potentially oversold, which could encourage the market to start to buy in again. So let's have a look at some of this. So here's our RSI, okay? So this is obviously our round about above our 70 level. This is round about our 30 level, as you can see. Let me turn myself off so you can see it. See in a minute. So here we go, 30 and 70. Okay, so remember the theory. If it hits around 70, the market's overbought, indicating the market could potentially start to sell off. If it's around the 30 level, it's oversold, so the market could then start to jump in and start buying again. So let's have a look. 30, around the 30 level, indicating potentially the market is oversold and the asset starts to move higher. Around the 70 level, the asset starts to be sold off. At the 30 level, indicating potentially that it's oversold, market starts to buy in again. And there we go. This is, like I say, this is why I like to show it working and not always working. Here, nowhere near the 70, nowhere close to the 70. And what does the asset do? Still, it starts to be sold off. And there's quite a dramatic sell-off here. Okay. Same time, here we go again. Round the 30 level, indicating it should be oversold. But what does the asset do? It continues to start, dropping. It doesn't start to buy in again till a bit later. So again, it's not actually giving us a clear indication there. It's not actually working. Here's the 70 level, but indeed, it does start to sell off. So obviously that was clear that time. Again, nowhere close to the 30, but what does the asset do? The asset starts to move higher. And again, this time around the 70 level, and indeed the asset is indeed sold off. So my point being, the relative strength index is what's known as an early warning indicator. And though you can see that sometimes it's giving you a clear indication, like all indicators, it's not taking into account any other external factors, things like that. So like I say, it's not always 100% accurate. And let's do another example. Around the 70 mark, yes, indeed, the asset starts to sell off. Around the 70 mark, indeed, the asset starts to sell off. But again, like if we look here, it's nowhere near the 30, but the market started to buy in. So again, not giving us a clear signal there. At the 70 level, market starts to sell off. Again, though, very, very near the 30, clearly showing it's oversold, but the asset continues to fall. So again, not always a clear signal. Other events and other webinars I'll be holding. On the 7th of August, I will be doing one is how I overcame the fear of trading. Let me put myself back on. Yeah, here I am. How I overcame the fear of trading. Followed by, after that, on the 14th, is how I started to learn about support and resistance. I've talked about support and resistance a lot today. So we'll talk a bit more detail about that, like how to calculate it, you know, and some of the trading techniques you can do using support and resistance. 21st of August is how I started to understand gold trading. I do have a bit of a history and relationship with gold. And the 25th of August is how I learned risk management, which I think is key, one of the key ones to pay attention to. If you'd like to speak to me or have any questions or suggestions for future webinars or any ideas, please feel free to email me at james@strattonmarkets.com. Or indeed, you can even follow me at Twitter if you like, or send me a direct message with my massive following, 47. But anyway, feel free to follow me. That's how you can contact me. Now, like I've said, I have been talking about CFD and online trading. And like any investment, it does indeed carry a great deal of risk. So I do suggest you do your own research and due diligence and know the risks at hand before entering any trade. Now, on that note, if you have any questions or anything like that, like I say, you have my contact details. So please feel free to obviously contact me. There they are again, James@StrattonMarkets, or indeed my Twitter handle. Till next time, and I hope to see you again. Till next time, can I wish every single one of you either a good morning, good afternoon, or good evening, or even a good night, depending where you are around the world. Until next time, every single one of you, trade safe.